on the show today. And Adrian, hi, morning. Thanks so much for joining us. Give us a sense of what we can expect to hear from this meeting. What could be the possible talking points on the agenda today? Do you believe that this rare earth metals issue could finally be addressed today and we could have some clarity there?
I'm not overly optimistic about the meeting between the US and China. The Chinese are very well prepared for the trade dispute that's in place. I don't think they're going to sort of roll over and give significant concessions, particularly around tariff levels. There may be a few token concessions with regards to non-tariff issues like restricting rare earths. As I look at capital markets, which essentially seem to have priced out any trade dispute now and have a very sort of optimistic outlook, I would tend to be a little bit more cautious about risk assets when they're taking such an optimistic view. I go back to this, the Chinese are very, very well prepared for this dispute with the US. And it's not in their interest to give concessions that are one-sided. So I think these negotiations could prove to be pretty tough.
All right. Adrian, also give us some sense that how do you see the fund flow shaping up between the U.S. markets as well as emerging markets? Because for U.S., we do see a strong May jobs data, the trade talks are on, while for the emerging markets, because of the rate cuts, some of these emerging markets are having that fillip, including India.
Yeah, so the labor market data looked good, but then if you looked at the revisions, there was quite significant revisions down of job growth. And there was something like 300,000 layoffs. So we are beginning to see some evidence of a sort of weakening of the US economy. Now, with regards to fund flows, I think they're going to be quite favorable for emerging markets, including India. We have a weak dollar, and that gives flexibility, and the RBI highlighted that flexibility with a 50 basis point cut in interest rates in India. The INR, which had been relatively weak up until a few months ago, is strengthening in line with other currencies that are strengthening versus the US dollar. And I think this puts emerging markets very much back in favor again. And India, as one of the major emerging markets, is going to be a beneficiary of that, as will China and as will Brazil, etc. When I think about this situation, if we can have a US economy that's slowing, a weak dollar, and the rest of the world sort of doing okay and sort of managing around these trade disputes, then I think EM equities do very well. I'd also highlight, when you think about flow of funds, we've lived in a world where dollar assets have been favored for many years. Many investors have sat with unhedged positions long US dollar assets. Their lack of hedging is a problem now, as when they convert their gains into their own currency, it's much lower because their currencies are appreciating. So I think the flow of funds out of US assets has really just started. Again, that will favor emerging markets, both for debt and equity. I would also highlight that, when we look at the tariff story and this trade dispute, we're sort of focusing on that too much, and we're not focusing enough on how serious fiscal positions are in the developed world. And the issue with fiscal positions is this movement away between a primary deficit that doesn't look too bad, but a rapidly expanding secondary deficit. And what that means is, because the price of money has gone up, borrowing costs have gone up, and the level of debt has gone up, that the real fiscal strain is the interest burden. And we need to see fiscal reductions. We've got to see less spending, more taxes in the United States, to a lesser extent in Europe, maybe more concentrated places like the UK, where the fiscal position is weaker. Again, I think that makes emerging markets look more favorable because they don't seem to have the same stress. India's cutting rates, China's been cutting rates. So I think there's a very nice setup in place here. I think we're going to get a better opportunity, though, to add EM risk, because I do expect these trade deals to prove more difficult between Europe and the United States and between China and the United States, and that might provide an opportunity to add more risk in EM. But I'm pretty bullish about the EM story.
I was just going to come to what you were talking about, Adrian, when we started off your answer. You were talking about what the central bank positioning has been. And just this week, you've got the BOJ, the ECB, the BOE, all their representatives speaking. I'm wondering, at a time when pretty much all central banks are easing rates, why is the BOJ and the Fed still holding fire?
Yeah, so I think the BOJ, remember, the BOJ is trying to tighten monetary policy, not loosen monetary policy. And I think there's good arguments for them to be cautious in tightening policy, as there's already an implicit tightening in the fact that the yen has been appreciating versus the US dollar. The Fed, we were referring earlier to the job data. The US economy is still expanding, and inflation still remains high. And the impact of the trade dispute and higher tariffs, and remember, we've got a flat 10% tariff on all imports coming into the United States. The Fed is understandably cautious about the inflationary impact of that. But let's go back and think about this move from dollar assets, from US equities, US bonds, into other assets. If I've got the I've got the European Central Bank cutting rates, possibly Bank of England cutting rates. We've got easing in the major EMs, whether that's India or China. That all makes these other markets, these other assets look a lot more attractive than having US equities, US bonds.
Okay, Adrian, point taken. Thanks so much for joining us on the show and speaking to us this morning. Appreciate your view. But with that, viewers, while we were talking about central bank action, let's understand the implication of what we've seen on Friday. Remember, a 50 bips